Uh, we can begin. This is Startup Tax Strategies with John Pennett, and I will have him do his own introduction and then get started with our session.
Great. Thanks, Jamie. Appreciate it. So I'm John Pennett. I'm a partner at the firm of EisnerAmper. We're a full service accounting and consulting firm. I'm the partner in charge of the life sciences industry practice for the firm, and I'm also a member of the Mid-Atlantic Bio Angels. So some of the perspectives I will provide today may have a little bit of the angel flavor to it as well. But let's get started. So we're going to cover just a couple of key things today, really, which is R&D, because R&D expenses for tax purposes is both a good guy and a bad guy. And we need to spend a little bit of time to go through what each of those good parts and the bad parts are, because that does have an impact, significant impact for early stage startup companies. And then we'll cover a couple of other key things that early stage entrepreneurs should keep in mind from a tax perspective. Okay, so first, just a quick reminder in terms of what R&D expenses are from the internal revenue perspective. So new and improved product or process, technological in nature, and a process of experimentation to eliminate uncertainty. So for most of the folks at the center, those would be the typical activities that we would see where you're trying to come up with a new or improved product and you're following these steps. So most of the work that you're doing should fit squarely into this category. Okay. For those of you who are kind of health tech or using some software, there's a couple of additional thresholds that you have to be aware of. Most important, but following the same type of guidance there, right? So it has to be new or unique, and there has to be economic risk of building that software product. Okay. So the two things we're going to talk about is the R&D tax credit, which is Internal Revenue Code Section 41. That's a good guy. And R&D capitalization under Internal Revenue Code Section 174, that's a bad guy. But we'll cover both of those two things today. Okay. So first for the R&D tax credit. So this is a dollar for dollar tax credit that is going to be available to the tax holder. And so first we have to define what are the qualified research expenses for just the R&D tax credit. So it includes in-house research expenses such as labor. So that's your employees, could be your contractors as well, and your supplies. Okay. And it could also include your contract research expenses, but only up to 65%. Okay. And if you are a kind of a health tech company, it would include the cloud hosting environment as well. Okay. So this is a little less inclusive than the definition I mentioned earlier, and that's by design. So the Internal Revenue Code, for purposes of the credit, is not quite as inclusive as we'll come to later in the overall definitions. Okay, so this also includes, obviously, all the people who are directly involved in the research. So these are the folks with the lab coats on, and people who are doing direct supervision and support of those research activities. It also will include if you're using some lab workers, if you're using some third-party services to help with some of those things, but it does not include any of the G&A services. So for an example, if you're using a payrolling company for processing payroll, that does not count. So it's really the direct costs of the R&D team and their support and support systems that go into the project. So, and for rough parameter purposes, you can think of those categories. I'll just go back to these for a quick second here. So of these categories here, there's different percentages that go into each one of these, but roughly think 6 to 8% of the expenses that qualify, these qualified research expenses, tallies up to be what your R&D credit will become. Okay, so if you spend $100,000 in these categories, you get the credit of $6,000 to $8,000, depending on which buckets that you go into. Okay. So the next question would be is what do I do with these R&D tax credits? Okay, so it's a dollar for dollar credit. So if you have taxable income, you can use that as basically prepaid taxes. So you can say, apply my R&D credit, reduce my tax bill. That's a good thing. Um, Obviously, you have to have taxable income. So if you're planning on perhaps doing an out-licensing transaction, or you have some revenues from other sources where you have taxable income, you could use that in today's dollars to offset that tax bill that will become due. You can also use, in certain circumstances, that R&D tax credit, sort of like a debit card, to be used to cover the FICA match on your payroll. So the FICA match is the 7.65% match that the company has to do when you pay people. So it's the Social Security and Medicare tax that's included in your payroll. This is the company contribution, not the employee withholding. So you can use that. You basically give the R&D credit to your payroll provider and say, use this sort of like a debit card to offset that. Now, there's a few rules in order to be able to take advantage of that. So the biggest one actually turns out to be number 3. So no gross receipts in any of the preceding 5 taxable years. Okay, so if you have grants, that's a receipt. In theory, if you have interest income, that's a receipt. So it becomes a little bit limiting in some cases, but if it's truly an R&D startup and you're pre-revenue in all respects, funded by shareholder investment in the company or safes, then you may be able to take advantage of this. This is a powerful benefit in that it saves you real dollars today, because when you pay your payroll, if you don't have to pay the FICA match, because of this debit card type concept, that saves you cash dollars today. So very powerful. So you should definitely take a look at this and take advantage of it when you can. You make an election to do this, you file that with your tax return, and then you work with your payroll provider to apply it. Okay. Okay. So that's the good guy. Now we'll talk about the bad guy, which is Section 174. So for 67 years, there was an element of the Internal Revenue Code, which basically said that a taxpayer may treat their R&D expenditures as a current tax deductible expense. Okay, so that's been very powerful, obviously, for R&D oriented companies to say, I can get a tax deduction for all of those expenditures made. Okay, so starting in 2022, that rule became rescinded. And the rule that's in place now is that no deduction is allowed for current spend of R&D expenditures. Instead, you treat it like a fixed asset, which you capitalize for tax purposes and basically depreciate over 5 years for domestic expenditures and 15 years for foreign expenditures. So you ultimately get the full deductibility, but you do not get that until 5 years down the road. So over 5 years. I'm sorry, make it clear, over 5 years. So think about that from the perspective of someone who gets, let's say, an SBIR grant. You have $100,000 of grant income, that's taxable income to you. And let's say you spent all of it on R&D expenses. But if you're only allowed to amortize over 5 years, you would get a $20,000 tax deduction, and you would have $80,000 of taxable income. If you combine the federal 21% plus states, let's say another, 8%, 9%, we'll round it up to 9% to make the math easy. So if you were at a 30% effective tax rate on $80,000 worth of taxable income, you have to write a check out for $24,000 to the Internal Revenue Service in the state of Pennsylvania. So that's a terrible answer. There's been lots of lobbying going on with respect to this. We'll get into that a little bit later, but that is the rule today. So how does this, what is the unintended consequences that come out as a result of this? So companies that you think of as break even, like a company with an SBIR grant, they usually operate at a zero taxable income base. You basically spend all the money you got. But if you have to add back some of that R&D expense, that will put you into a positive tax position. That's a bad place to be. It also has an impact on your net operating losses. So if you have taxable income, you may be able to use your R&D tax credits, which we just went through, to offset some of that. That's a good guy. You may have had net operating losses in years past, which you can use to offset a portion of the current year's taxable income. So those things have a unintended consequences on putting a lot more pressure on your taxable income scenario. You would not think a company with a small amount of grants actually has to think about tax planning, but because of these rules, you actually do need to think about tax planning. Okay. So just to give you a little bit of the perspective, as I mentioned, that there is the slightly different definitions of what types of expenses are included in these two tax code sections. So section 41 is the good guy, section 174 is the bad guy. And of course, there's more X's checked in the bad guy category than there are in the good guy category. So that's the IRS saying we'd like to get as much of that deductions deferred over that 5 years as we can. So again, that is not helpful for us. Okay. So we had hoped, going back after the rule became in effect in 2022, that this was going to be reinstated. So there was a bipartisan tax deal that was put in place after lots of lobbying and contacting of the Congress by local representatives of bio associations and R&D associations and universities, et cetera, that this would be reinstated back to its format that we had for all those years, and the R&D expenses would become currently deductible. That never passed. So for 22, 23, 24, and who knows how long into 2025, we're going to have those same rules in place. I think most people would agree that this is very contrary to an innovation economy. It's very hurtful to innovators and is causing companies to have to rethink how and when they spin out from universities and other startups and how they finance the company. So as a result of that, it has had a significant impact on companies and the speed of what they say. So we are hopeful that these will be reinstated, but that's what I said last year. We now have a new administration. There are lots of priorities. I'm not sure how high this is on the priority of things to be addressed by our current legislature. So my suggestion is to the entrepreneurs listening to this is to talk to your tax advisors, understand what is your R&D expenses, go through those different categories, and do a rough calculation so you have an idea of what your tax burden may be. And hopefully your accountant, if they're familiar with these items, can help give you some guidance and suggestions. Okay. Just want to mention a couple of other things very quickly, which are important for early stage entrepreneurs to think about from a tax perspective. So the first of which is Internal Revenue Code Section 1202, which is the qualified small business stock exemption. This is a very powerful code section. You'll see that venture capitalists or other investors will talk about this when they're considering making an investment in your company. But there are some very specific rules that have to come into place. The power of this is that you are able to exclude somewhere between 50 and 100% of capital gains up to $10 million through this exercise. So very powerful in terms of that for the stockholder. That stockholder can be an investor or a founder, either of which works, but it has to be a C corporation, not an LLC. You have to hold the stock for 5 years, and then you have to sell the stock. So in other words, the company gets sold, not an out license of technology, not the sale of a technology, but the sale of the company's stock to a third party. So you'll see investors uh, pushing companies towards converting from LLCs to C Corps. This is one of the main reasons why. Very powerful thing. You have to make sure you document when everybody gets their shares, make that sure that's very clear, and put all that stuff into your vault. Okay. Um, Along those same lines, I'm going to jump to the second item here, which is the 83Bs for those of you who are founders. If you receive stock as part of your founder shares, you should make sure that you have those, again, clearly documented. If you're going to pay for those shares, make sure there's a clear banking transaction that shows the date that that happens. That becomes critical for that 5-year holding period. And if you're going to file an 83B election, which your attorneys should be discussing with you, you have 30 days to make that election. So it's very time sensitive from when you get those shares. So keep that in mind. The 83B filing for a startup company is a pretty powerful tool as well for you personally. It's not a corporate decision, it's a personal decision, but a powerful way of doing that. Along the same lines is the 409A valuation. So this is when you want to give stock option to some of your key employees. So you're supposed to give the shares, the strike price of the stock option should be equal to the fair value of the shares of stock that you're issuing. So common shares, at the very start of the company, most people use par value. So from a timing perspective, if you're going to use par value as a proxy for fair value, you want to do that as early as you can before you have a priced round or you have other significant capitalization and corporate activities so that you can say that the par value is a reasonable proxy for fair value at just slightly above zero. Over the course of time, as more things and more activities happen and you raise money, the valuation of the common stock becomes mathematical as opposed to judgmental. So you need to have that documentation of what that fair value is done under a 409A valuation. That takes a little bit of time, a little bit of money, and there's also not as much benefit to the employee because now you're doing something at something that's most likely above par value or something slightly above zero. So timing is really important on that. Documentation is super critical. For any of the stock transactions, make sure that you document them clearly and put them in your vault for safekeeping. Going back into history of stock transactions is always a troublesome area, and there's been lots of lawsuits and problems and tax issues resulting from not doing that clearly. And so the final thing I just want to mention is, keep an eye out for state credits and incentives. So all states are being aggressive in terms of trying to get innovative companies to come to their state, their city, their economic zone, et cetera. So keep an eye out for that. Look at the documentation of those transactions that are required. Look at the application dates and the due dates and make sure you take advantage of all those credits that you can. Every little bit helps. States are being very aggressive in trying to recruit companies. So all states are constantly re-looking at, reimagining what these programs may look like. So for entrepreneurs, take advantage of those as much as you possibly can. Okay. And I think that was basically it. I'm going to skip over the New York City Biotech Tax Credit. And that's my information and my colleagues' information as well. I'll stop there and Jamie, Christy, I don't know if there were any questions or if we stop there.